Okay, here we are, last section of today's lecture about stocks and stock markets. Let's just talk a little bit about asset bubbles and stock market crashes. Cut from today's headlines, right, where we've had all this financial chaos here the last couple of months. How are we to understand some of this? So first off, what is an asset bubble, right? What is an asset bubble? How do we define what an asset bubble is? Well, I'll kind of put up the definition that economists use here of an asset bubble. An asset bubble is when prices, excuse me, when prices are greater than what can be justified by fundamentals. In other words, based on knowable information, right, about this firm's profits or their dividends or their future growth rates. When prices differ from that, from economic theory, we would call that a bubble. Joseph Stiglitz has another definition, which I think is related to this. He says, if the reason that the price is high today is only because the investor believes the selling price is high tomorrow, when fundamental factors do not seem to justify such a price, then a bubble exists, right? This gets back to the greater fool theory of investing, right? If I'm buying, not because I think the price makes any sense, but because I think there's even other people out there that are stupider than me that I can sell it to for an even higher price, that's probably a bubble, right? Bubbles are most likely to take place in long-lived assets, such as stocks or real estate. These are assets that don't have any maturities and have long horizons, and it's very difficult to measure their true value. And as a result, they're very vulnerable to speculative behavior and psychology, right? And so these things have happened throughout history, right? The first stock bubble, stock here in parentheses or in quotation marks, was in Amsterdam, the tulip mania, right? Where tulip bulbs, which is a long-lived asset, became so popular that prices rose by nearly 6,000% before there was an eventual collapse. And what we've seen throughout history is if you look at any sort of stock market, you see these booms and busts, right? Where prices go up dramatically and then prices drop dramatically, sometimes by as much as 80 to 99% of their value. And so, this kind of boom bust cycle we see in many financial assets, particularly stocks and in real estate, which are the longest lived, right? Data suggests that the average recession that results from a stock market lasts about 3.5 years, stock market crash. So this is one thing to keep in mind when you think about whether the US economy is going to recover quickly from this pandemic. Evidence suggests not so quickly, right? That whenever you have a big stock market crash, the economy is slow to recover because there's a lot of loss of wealth, right? And also it impacts a lot of investment decisions and a lot of activities of firms and employment choices, going to college choices that tend to have very, very long lasting impacts. There's really two theories of what causes asset bubbles. The first is that they're driven by psychology, right? That they're largely a psychological thing. Charles Kindleberger, who's kind of the father of asset bubbles, has kind of a theory of asset bubbles in which he focuses on four things. First off, that we have manias and panics in our psychology. We just tend to overreact to information. We also tend to behave very irrationally in the short run, such as herding, right? We see other people doing it and we want to do it too, even if it doesn't make any sense to us. Finally, the third thing here is that Kindleberger observed that oftentimes in the buildup, in the boom period, there's oftentimes some sort of financial innovation that's taken place. In other words, something different is occurring in the economy. And the reason why this different is so important is that it gives people a narrative that this time it's different than the past, right? You've heard me say this before, but the most expensive words in finance is, this time it's different. And so we tend to see this during booms and busts. People will say, oh, no, this is different now because this, right? Whenever a narrative develops in which people are able to say this time is different, it essentially begins to fuel that mania and then eventually the panic. And then the final thing is Usually one of the things that drives asset bubbles is when it becomes very easy to get credit, right? And so this suggests that moral hazard is a big part of what goes on, that people find it easier to borrow money. And when you borrow money, that encourages you to engage in riskier behavior. And so Kindleberger said the asset bubble is always predicated by the asset boom, right? But then there's something that triggers a pop, like a panic selling, or there becomes too much leverage. A few bankruptcies take place. All of a sudden, people begin to look around and say, what's going on? Oh, maybe I better rethink what I'm doing. Maybe I need to get more conservative. Maybe I need to sell. Panic selling begins to take place. And what was a boom quickly becomes a pop, right? And the whole thing is psychological, right? There need not even be any new information. It's just the worry that something could go wrong that could do it. In other words, to the extent that asset bubbles are driven by psychology, there's a self-fulfilling aspect to this, right? That the bubble occurs because you think a bubble is going to occur, and then the pop occurs because you think that a pop is going to occur. Other economists have focused on fundamentals-based theories of asset bubbles. And what they're saying here is that it's not all psychology that leads to asset bubbles. There's also some real incentives that encourage asset bubbles, right? For instance, investors' returns are linked. This is Keynes's beauty contest theory, right? That what you think makes sense also makes sense for me to do. And that creates this herding behavior that isn't necessarily irrational. It's actually quite rational, right? If you think everybody else is going to like a stock, then you should like that stock too, because they're going to bid up the price. And so maybe you want to get in on it. These theories often focus on the role of regulation and the lack of regulation leading to a lot of moral hazard behavior that creates incentive for people to engage in risky behavior. What's fueling this moral hazard? One thing could be financial liberalization. In other words, eliminating regulation, right? Eliminating regulation that allows banks to make risky loans, that encourages financial markets to engage in risky lending behavior, to issue a lot of debt. And of course, when people are using other people's money, they tend to engage in moral hazard and engage in very risky behaviors. These theories, these fundamental-based theories, also focus on financial innovation, right? The fact that, once again, this time it's different. And oftentimes, financial innovation isn't just about being more profitable. I'm sorry. I think my phone is going off. Siri's trying to help me answer this question. Stupid phone. But oftentimes financial innovation is not because it's more profitable, but it just allows you to avoid regulation, right? And so these fundamental-based theories often focus on the role that avoiding regulation, and without regulation, you get a lot of moral hazard behavior because it's essentially asymmetric information encourages people to engage in riskier behavior, right? Regardless of whether you think it's belief-based, meaning psychology, or fundamental-based, meaning lack of regulation and too much moral hazard, both of these theories do share some similarities. First off, they both believe moral hazard is a big part of the boom-bust psychology. And also, they both agree that there's a need for prudential regulation, right? That there's a reason why governments should be involved in financial markets, because without it, there's going to be this tendency toward manias and panics, right? So, one of the things that we've observed across countries is that real estate and stock prices tend to rise by 40% after big financial deregulation packages, right? And that if you look across countries, stock bubbles are most likely to occur when there's very little financial information in a country, when a country has weaker institutions, such as weak legal systems, and when financial markets are not developed, right? And so if you think that asset bubbles and stock market crashes occur too regularly in the United States, go to a less developed country, right, where there's little financial information and they have weak institutions and weak financial systems. There you'll see stock market crashes occur even more commonly. Should central banks try to pop bubbles, right? In other words, should the Fed have been trying to pop the US stock market before the pandemic occurred, right? Because there was some talk the stock market was overvalued. The stock market was poised for a big drop. Should the central bank be trying to like trigger these drops? In other words, letting air out of the bubble before you get the big blow up. I think that the agreement among most economists is that that's unlikely to work. That it's one of those ideas that sounds great in theory, but in practice, it's really hard for central banks to pop bubbles beforehand. For one, as noted by the former chairman of the Fed, Ben Bernanke, popping a bubble with monetary policy is like performing surgery with a sledgehammer, right? The only tools that the Fed has is changing the money supply and changing interest rates. That's not just going to impact the stock market, that's going to impact everything, right? It's going to impact everything. And so it's not like a fine tool, right? It's not a fine tool. And that's why it's probably not very good for central banks to try to do this. Robert Lucas is skeptical that central banks can do this because, his idea is if policymakers could predict bubbles, we couldn't afford them. They would be out investing on their own and becoming billionaires, right? and the point he's trying to make here is everybody tends to be engaged in hindsight bias here. After the market crashes, everybody says, oh yeah, I knew that was coming. But the reality is, even if you think there's a bubble, you don't know exactly when it's going to pop, right? I'll just admit this story to you, right? Is in 2008, the stock market bubble, right? When that popped, when the stock market went down by 50%, I remember a year before having a conversation with a good friend of mine. He's my college roommate for 3 years. He's somebody that works on Wall Street. And so a year before the stock market crash, I remember talking to him and I was trying to tell him, I think there's a stock market bubble here and all these mortgage-backed securities. This looks like a disaster waiting to happen. And he said, I kind of agree with you, but the fact of the matter is if I get out now, I might miss a year or two of the bubble, right? That could be my job. And, I think that's right? I mean, I might have been right that there was a crisis coming, but I was thinking the crisis was coming as early as 2006. I would have missed 2 years of the buildup. And who knows whether I would have lasted that long, right? If I was really betting my life savings on this, I might have said, I've been wrong for 2 years. I'm going to get back in the market, and ended up getting right back in right before the market blew up, right? I mean, timing is everything in this. And it's really hard to time the market because most people, even a genius financial investor like me, doesn't have better information in the market, right? And so, if individuals don't have better information in the market, then it's also not clear that policymakers always have better information in the market. So most economists think, really the best way to avoid asset bubbles is to try to encourage prudential regulation and try to make sure that there's not too much of a buildup in crazy borrowing and moral hazard behavior. But the fact of the matter is, stock market bubbles and stock market booms and busts, they just happen. And, if you can't take being engaged in a stock market bubble, you probably shouldn't be in the stock market, right? The best way to protect yourself from a stock market bubble is simply to follow that buy and hold strategy, right? So put your money in the stock market and forget about it for 20 or 30 years, right? And so, for me personally, I haven't looked at my retirement account since this whole thing began because I don't want to see how much money I've lost over the last 3 or 4 months. But part of the reason is I'm following a buy and hold strategy. I'm not saving for today. I'm saving for, down the road. And that's, I think, the best way not only to be sane, but also to be a good investor, right? To the extent that you can, just try to follow the market, but try to follow it over the long haul and just, try to ride that bucking bronco, hopefully thinking that, you might get kicked off a few times, but over the long haul, you'll be able to stay on it long enough to make it worth your while. I don't know if that was a very good analogy, but work with me. So, all right, I think that feels like enough for today. All right, that was a lot of lecture on the stock market. Hopefully, though, you find this lecture useful and interesting. There's a little bit more in this lecture than is in your book. I think you'll find that chapter 7 kind of focuses on the first 2/3 of what I talked about. And then, as I said, some of this discussion here about new issues in financial markets and behavioral economics and stock market bubbles is more material that I'm giving you. I'm not giving you any additional readings for it, but hopefully you can just kind of follow my notes and get enough out of this to be prepared for the exam. And of course, if you have any questions about this, that, or the other, you can always come to office hours and ask me questions about it. Remember that your homework number 1 is due on Friday, which should be today, if you're watching this on the schedule. And so make sure that you turn that in by midnight tonight. Remember that to study for the first exam over the weekend, the first exam is on Tuesday. All right, so get prepared for that. We'll have some opportunity to review for that in office hours next week. All right, all the best. Stay well, stay healthy.